Okay, so just a little bit of background on what exactly is a trust. A trust is a legal relationship, right? Whereby there's a founder or a donor who places an asset under the control of the people called trustees, right? So the main three parties of the trust are, the founders. So the founder is the person who creates the trust. Then there's the trustees, and the trustees are the people who act on behalf of the trust, because remember, a trust is not a natural person, so it needs people to act on its behalf. So those are the trustees. They administer the assets of the trust. They're the ones that get to decide to say, okay, we are paying out this, we are paying out that, and all of that. So those are the trustees. And then finally, there's the beneficiaries of the trust. So those are the three people in a trust: the founder, who creates the trust, the trustees, who are just acting on behalf of the trust, and then there's the beneficiaries who benefit from the distributions of the trust. So why are trusts established? For estate planning purposes. For example, estate duty. You are familiar with estate duty, right? Are you there?
Yes, can you hear me?
Yeah, I can hear you now. Are you familiar with?
Yeah. Yes, I am.
Yeah, so estate duty, like the estate duty tax is very expensive. So then people, what they try to do, that's why people establish trusts to avoid estate duty, because if your assets are now in this trust, then you're not going to pay estate duty. Get what I'm saying? So that's why people establish trusts. And also when assets are inside a trust, for example, if I have property and a couple of assets and I decide to keep them in a trust, no one can access these assets. So if I've got debtors, if I owe people and stuff like that, when these assets are in a trust, they are protected from debtors. From creditors. I mean to say, yes, are protected from creditors and stuff like that. So yeah, and then also people will establish trusts, maintain and provide for their beneficiaries after they've died. So I can decide that, you know what, I've got kids and I want them to be well taken care of when I die. So what can I do? I can establish a trust, and long after I'm dead, they can still be receiving income or assets or whatever from this trust. So those are some of the reasons why people establish trusts, right? So there are two different types of trusts. There's what we call an inter vivos trust, or a living trust. Okay. And this is a trust that is created by a person during their lifetime. Like, you are alive right now and you decide, you know what, let me create a trust. And then the founder of the trust will then sell or donate assets to the trust. And yes, and then there's what we call a mortis causa trust, or a testamentary trust, and it is established in terms of a person's will. So the person will say, you know what, on the day that I die or when I pass on, I want you to establish a trust, and I want all my assets to go into a trust. So basically, hello?
Oh, I got kicked out. I don't know what happened.
All right.
I'm not sure what. Okay. You were talking about inter vivo and the other one, the two
Yes.
types of trust. Yeah.
So I was saying inter vivos trust is when like it's established during the founder's lifetime. So it's established when you are alive and you decide that, you know what, I want to establish a trust. So that's an inter vivos trust, right? And then
Okay. Yes, I'm listening.
And then a mortis causa, or testamentary trust, it is established in terms of a person's will. So the person will have a will, and in the will, he will write that when I die, I want a trust to be established. So then a mortis causa trust, also known as a testamentary trust, will only come into operation when the person passes away. So that's when the trust will be established to say, okay, when I pass away, I want you guys to take my assets and put them in a trust, and I want this, the assets to take care of my family. So that's a mortis causa trust or a testamentary trust. Whereas an inter vivos trust is when the person is alive and he decides that, you know what, I want a trust whilst I'm still alive. Yes, so those are the different types of trust. And then there's also what we call an ordinary trust and a special trust. I think most of the times, I think at third year level, you'll be tested on ordinary trusts and not special trusts. So an ordinary trust, the tax rate of an ordinary trust is 45%, okay? And so, for example, if the trust has income, taxable income of 100,000 Rand, the tax on this trust will be 45%, which is 45,000 Rand, right? And then when it comes to a special trust, the rate of a special trust is not fixed at 45%. So it has a sliding scale. So you see the same sliding scale that you use for a natural person, that same tax table that you calculate tax for a natural person is the same table that you're going to use to calculate tax for a special trust. But like I've already said, I don't think at third year level, you will be tested on special trust, but you will be tested on ordinary trust, and the tax rate is 45%. Okay, so I'm not going to get into special trusts because I don't think they're part of your scope, right? So now, like I've already mentioned, there's three parties to a trust. There's the founder, who is the person who establishes the trust. There's the trustees, and the trustees are acting on behalf of the trust. So they are the ones that decide, okay, we are going to give out income to who, we're going to do this, we're going to do that. So those are the trustees. And then there's what we call the beneficiaries. So the beneficiaries are the ones that have the rights to income and capital, so, or to income and the assets of the trust, right? So now there's different types of rights that these beneficiaries have. And the types of rights that these beneficiaries have are very important to identify in a question, because they determine how the beneficiary will be taxed, right? So there's what we call a vested right. So when we say vested, we basically mean that the beneficiaries are entitled, the key word there is entitled, to the amount or the assets, and they have a legal right to claim the income and the assets of the trust. So there's what we call a trust deed. It's like a document which documents the trust, who are the beneficiaries, every information relating to the trust. So this trust deed, it will write that, okay, Dineo has a right to receive rental income, or Asanda has a right to receive the property or whatever. So that information will be in the trust deed. And then a vested right means that you are entitled to it. Like I must get this income on a monthly basis. But a discretionary right now, it means that beneficiaries have a contingent right to the income or assets of the to the income and assets of the trust. So basically, discretionary right means that the trustees will then decide, are the ones who have the power to say, okay, this month we are not giving Asanda rental income, we will give her next month. Or this month we're not giving her interest, we will give her next month, or we will give her next year. So that means that it affects how this person will be taxed. When this person has a discretionary right, the right is contingent, it is dependent upon the trust deed, or the trustees deciding that, you know what, we are giving you this, we are giving you that. So the two types of rights are very important in your question, like I already said, because they determine how the person will be taxed, right? So who is taxed on the income and the capital gains or whatever, the CGT of the trust? So the taxation of trust is governed by Section 25B, right? And what do you guys have to know? number one, there's what we call the conduit pipe principle, okay? And the conduit pipe principle basically says that, for example, if the trust receives dividend income, right? Remember the trust, this income is received on behalf of the beneficiaries, right? So basically, if the trust receives dividend income, this income will flow into the trust as dividend income, and then it will flow out of the trust as dividend income. So that's what the conduit pipe principle is. So when the trust receives rental income, it will get into the hands of the beneficiary as rental income. It does not change its nature, right? So basically they're saying that the trust is like a pipe. Basically, it's just a pipe in which income flows, and it comes out the same way it flowed into the trust, and it comes out the same way into the hands of the beneficiaries, right? So very important, there's a specific order of persons who may be taxed on an amount earned by the trust. So remember, a trust can have assets, it can have shares, it can have literally anything, right? And this income will flow out of the trust, and there's an order of the people who will be taxed on this income. So your question will ask you for tax in the hands of the donor or the beneficiaries or the trust. So you must know the order of the people who are going to be taxed on the income of the trust, okay? So number one, you first tax the donor of, so like if there's a trust and Asanda donates something to this trust, so first the income from whatever she has, if she has donated a fixed property, that's making rental income. So now you must try and establish who is going to be taxed on this rental income. So first you will tax the donor of the fixed property. And if you can't tax that person, then you will tax the beneficiary with a vested right. Remember, we said a vested right is like this person is entitled to receive this rental income, right? If you can't tax the beneficiary, then you tax the trust. So that's the order. First, the donor, if I can't tax the donor, I tax the beneficiary. If I can't tax the beneficiary, then finally, I will tax this rental income in the hands of the trust. So do you guys have any questions there?
I'm good.
Okay.
Hi, I'm so sorry I joined in late.
No.
I'm good so far as well.
Okay, so yes, so this order is very important because like I said, your question can ask you for tax in the hands of any of these people, the donor, the beneficiary, or the trust. So you must know when like your question will tell you the income and the assets of the trust, to say, this is how much income is in the trust. This is what, these are the assets that the trust has. So now you must know who is taxed on the income and who is taxed on the on the capital assets, right? So the order is donor, beneficiary, trust. Okay, so okay, can exemptions be claimed against trust income? Yes. So for example, I'm not sure if this one is part of your scope, but I'm just gonna tell you guys about it anyway. And I'll share these slides with you after the session. So can exemptions be claimed against trust income? Yes. So basically, after a person has determined the nature of all amounts received by the beneficiaries, it is important to note that any exemption from tax provided in the Act applying to that type of income will be available to that beneficiary. So if the trust has received interest income and a beneficiary receives this interest income, then the beneficiary can be able to claim an exemption against that interest income, right? Same applies to dividends. If the trust receives dividend and then it pays out the dividend to the beneficiary, the person can claim a normal exemption and a normal dividend exemption, right? However, there's this thing that happens with trust when there's dividend income, right? And the trust has received dividend income or whatever income, And instead of paying it out as dividend or as interest, they decide to pay it out as an annuity. So are you guys familiar with what an annuity is?
Yeah, I think I'm quite familiar with it. It can be paid annually or monthly, I think.
An annuity is like a fixed amount that the person receives. Most of the times it's monthly.
Yeah, okay, yeah.
So then when there's an annuity from a trust, if there's a beneficiary receiving an annuity from the trust, then there are no exemptions, right? There are no exemptions. Let me put it this way. The trust has received dividend income, and you know that when dividend income flows out of the trust, the beneficiary can claim an exemption, a dividend exemption. But when the trustees or the trust deed decides that, you know what, the beneficiaries will not get dividend income, but they will get an annuity from this dividend income. Are you guys following what I'm saying?
I'm following.
Okay, so in a nutshell, what I'm saying is when you see an annuity from a trust, you must know that most of the times that fixed amount will be from dividends and interest, and there will be no exemptions in that case. Okay.
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 Right. So the tax implications of loans to trust. So why do people make loans to trust? Remember, the trust has no money. If I want to sell my property to a trust, the trust has no money to buy that property. So what people usually do is that they will then say, okay, I'm going to loan the trust so that it can buy my property, or I'm going to just donate this property to the trust, right? But if the person doesn't want to pay donation tax, remember, if I have a property worth 5 million and I donate it to the trust, I'm going to pay 20% donations tax on that 5 million. So if someone feels like, you know what, I don't want to pay donations tax, I want to sell this property, but the trust does not have money. So what do? They then loan the trust. And so there's tax implications there, okay? So the tax implication is that the loan itself is not a donation, because you're going to get the money back after the property has been sold. That the trust will give you the money back, it will pay you back, right? So the loan itself is not a donation, but usually these loans will be interest free. So the difference between the market related interest and the interest that the trust would be paying on this loan, that's a donation, and then there will be donations tax on that. Am I making sense?
You said the interest that is on the market. Please explain that part again.
Okay, so I said that there's two ways. Remember, we are trying to get assets into the trust because we don't want to pay estate duty, because estate duty is expensive, right?
Yes.
So there's two ways to get these assets into the trust. We can donate these assets, but we will pay a huge amount of donations tax, or sell these assets to the trust, okay?
Yes.
But now the trust has no money. If the trust has no money to buy my property worth 5 million, what do? I give the trust a loan to buy my. Okay. So the loan itself will not have any implications, because it's I'm gonna get it back. I'm gonna get the money back. So it's not, it's not a donation. Okay.
Okay.
Now, the interest on the loan. If, for example, I gave the trust an interest-free loan, it means that the trust is paying 0% interest. So now, the difference between the market-related interest, if the market-related interest is 4.5% and 0% that the trust is paying, that's a donation.
Okay.
And then I'll pay 20% donations tax on that.
All right, I get it. Thank you.
Asanda, you get it?
Just a little. I think I'll be able to get it more when it's applied.
All right.
but I'm getting it a little.
Yeah, so basically, these are like these are Asanda, these are notes that I did a while ago. I just wanted to share them with you guys before getting into your TAT letter. So just to give you guys a brief background on trust before we look at your TAT letter. So now we can have a look at your TAT letter and do an example. I just wanted you guys to understand what exactly is a trust, who is who in the trust, and all of that. So I'm gonna open your slides right now, your TAT letter. Can you guys confirm if you can see it?
I can see it.
All right. Great. Yeah. So all right, so I've already okay, so trusts are established as a method of tax and estate planning. I've already mentioned that people establish trusts because they don't want to pay estate duty. It's expensive to pay estate duty, so they donate their assets into a trust because they feel like it's a cheaper option. So trusts have been used to limit the taxpayer's tax liability. Yeah, so learning outcomes after you've completed this learning unit, you should be able to calculate the taxable income of a trust, calculate the taxable income of the beneficiaries, and then discuss and correctly apply the Section 7 rules. So these are very important rules that we're going to get into, okay? So the nature of a trust. For tax purposes, a trust is a separate legal person. So the difference between the trust and a company is that a trust can distribute profits to a beneficiary, resulting in the beneficiary and not the trust paying tax on those profits, right? So if income, like I already said, if income, whatever income that comes into the trust, it will flow out exactly the way it is into the hands of the beneficiary. So if a company distributes profits to shareholders, it must still pay tax on that. It must still pay tax on that, but a trust is taxed after the beneficiaries have been taxed, and it's taxed on what is left in the trust. You get what I'm saying? So for example, if we received 500,000 Rand with rental, if the trust received 500,000 Rand worth rental income, and then it pays out 400,000 Rand and only 100,000 Rand is left, then the trust will be taxed at 45% on the 100,000 Rand, not the entire 500,000 Rand. Whereas with a company, if a company receives rental income, it must first pay tax on that rental income, and then if it's going to be making a distribution, it will then pay dividends tax on that rental income as well, if it's going to be paying it out as in the form of dividends, right? So that's the difference. We've already spoken about the rate. Trusts excluding special trust are taxed at a flat rate of 45%. Okay. So you should now be able to complete the following metrics, indicate who will qualify for which rebate, right? So very important. A trust will not qualify for your primary rebate, secondary rebate, tertiary rebate, and all of that, okay? Because it is not a natural person. But the beneficiaries now, the person who receives income from the trust or the donor, they will have a primary rebate, secondary rebate, tertiary rebate, and interest exemption, okay? Because these are rebates relating to natural persons. Okay, so person liable for tax on income of the trust, okay? So like I already said, there are 3 people who can be taxed on the income. Number 1, there's the donor. Number 2, there's the beneficiary, and number 3, there's the trust itself. So the trust will be taxed on what is left after making payouts to the beneficiaries. So then the trust will be taxed on what is left, okay? So if a taxpayer has a vested right to the income, he will be taxed on this income, whether it is paid out to him or not. Remember, vested means unconditional. I am entitled to receive this income. So that's what vested mean. And then discretionary means that I will only get this income if the trustees decide that, you know what, let's give her some income. Let's pay her something from the trust. That's so when I have a discretionary right, I will not be taxed until I actually get that income. But with a vested right, because I have an unconditional right to this asset or to this income, then I must be taxed on it immediately. Okay, are you guys following?
Yes, I'm following.
Yeah. So these provisions now, section 7 is very important, okay? So the first one is transactions between spouses, okay? So let me explain it this way. Okay, so basically this is an anti-avoidance provision, and it applies not only for trusts, it's just a general anti-avoidance provision. So what happens is that if I make okay, so let me give you an example. If my husband hires me in his workplace, and I'm supposed to be earning, say, 15,000 rand, but he pays me 30,000 rand just because I'm his wife, right? SARS will deem the extra amount to be income in his hands. Do you guys get it?
Yes, I get it.
Yes.
Yeah. So now, in the context of trusts, right? In the context of trusts, the same principle will apply. If my husband makes a donation to a trust, say he donates fixed property, okay? He donates fixed property and I'm a beneficiary, but I receive rental income from the fixed property that my husband has donated. Section 7.2, when that income gets into my hands, Section 7.2 will deem that income to be income in his hands. So I will not be taxed on it, but he will be taxed on it. You guys get it?
Okay, I get it.
Mm-hmm. And then the Section 7 subsection 3, and this one is an anti-avoidance provision for minors, right? So what people would do is that people know that minors are not taxed on income. Like if you donate something to a minor, it's not that they will not be taxed on that income. They are minors, right? So what then people would do is that they would say, for example, I've received income from somewhere and I do not want to be taxed on it. Then I would just give it to my child because I know that my child is a minor and my child will not be taxed on this income. So that's how these anti-avoidance provisions came, to say, okay, you guys are trying to dodge tax by hiring your spouses because you don't want to be taxed on that income. So you're giving it to your spouse. Number two, you don't want to be taxed on income. So you're giving it to your minor child because you don't want to be taxed on it. So Section 7 then deems that income to be income in the hands of the parent. Okay, so now in the context of trust or donations, like these provisions, like I said, they are not only for donations, not only in the context of trust, but even when there's like general donations, right? So in the context of trust, if I donate a property to a trust and my child is a beneficiary and my child receives income from that property, that income will be deemed to be income in my hands. You guys get it?
Yes.
Asanda?
Yes, I got it. Thank you.
Yeah. Okay. Another important one is donations between resident and a non-resident. Okay. So this anti-avoidance provision came about this way. Asanda, can you tell me how are residents taxed and how are non-residents taxed? Or anyone, or do you know?
If if I remember correctly, with the residents, they are taxed on their worldwide income, and then with non-residents, they are taxed on whatever income that is from a South African source.
Correct.
Yeah.
So now what residents used to do is, if for example, if a resident receives income from, say, Botswana or wherever, right? He knows that he will be taxed on worldwide receipts and accruals, right? So what they would do now is that they would give this income to a non-resident, because they know that a non-resident is only taxed in SA. So you see the things that people used to do to dodge tax. Non-resident is only taxed here in SA. So if I receive income from Canada or wherever, I can have this income go into his account, and then he will then give it to me. But basically is, I will dodge tax because this person will not be taxed on it. He's only taxed on income from a South African resident. So that's how this that's how this anti-avoidance came into the picture. So Section 7, subsection 8 then deems income, like if this income, for example, in the context of donations, if I'm a resident and I make a donation to a I make a donation to a non-resident, I will be taxed on that income. So in the context of trust, if I'm a non-resident, if I'm a resident and I donate a property into the trust and one of the beneficiaries is a non-resident, that income of the non-resident will be income in my hands, will be deemed to be income in my hands. So trusts are not very tricky. You just need to understand these anti-avoidance provision to say, okay, if there's a spouse involved, any income resulting from a donation made by her husband, it will be deemed to be income in the husband's hands. If there's a minor involved, income will be deemed to be income in the parent's hands. If there's a non-resident, income will be deemed to be income in the hands of the resident. So trusts are very easy. You just have to master these anti-avoidance provisions, okay?
Okay, got it.
So loans between trusts and connected persons. So I did explain this one briefly to say, I'm trying to get this asset into the trust. The trust has no money. So then what do I do? I fund the trust. I give it an interest-free loan or a low interest loan. So the loan itself will not have any consequences, but the interest or the free interest will have consequences, and the consequences are donations. So it says here that it can trigger the application of Section 7 due to the fact that the interest saving by the trust is regarded as a donation. So the interest saving is regarded as the donation, which is the difference between the market-related interest and what this trust is actually paying. So that's the donation, and then that means there will be donations tax on the interest saving, on the interest rate, on the interest saving by the trust, right?
Okay.
So yeah, I think those are just some of the important things. I'm not going to go through everything, so let's have a look at a question. Oh, okay, very important. There's also CGT. CGT, if someone sells something to the trust, there will be capital gains in the hands of that trust. If the trust sells something, then there will be capital gains in the hands of the trust, okay? So let's look at like a practical example. Asanda, you said you wanted to look at 15.2?
Whichever, 15.1 or 15.2.
All right. So let's look at 15.1 and then maybe we can look at 15.2. Right, can you guys see it clearly? Would you like me to zoom in a bit?
I can see.
Okay.
Yeah.
So it says here that you are a tax practitioner working in the Johannesburg area. One of your partners asks for your advice regarding the tax calculation of one of his clients, the Nduli Trust, okay? So you're dealing with a trust, the duty trust, and then you have received the following summary from the trust deed. Remember, I said the trust deed is a document that keeps all information regarding the trust. So the trust deed says that there's Mr. Nduli, a 45-year-old man, and he founded a trust on the 1st of March 2020. And the beneficiaries of the trust are his wife. Okay, so there's the wife who's a beneficiary. His wife, her name is Ramasela, 40 years old, to whom he is married out of community of property. So what that means is that whatever income that she gets, it will not be split 50-50 because they are married out of community of property. And then there's a daughter who is 17 years old and working in Johannesburg. She is married in community of property. Is this daughter a minor?
No.
No.
He's not a minor, right?
Yes.
She's married.
And then there's his son, Richard, who's 15 years old and still in high school. He's a minor. Okay.
Yes.
Right. So now we know who the beneficiaries are. Before we read more information, let's go see what the required ones. So the required discuss the tax implication of the 12,000 annuity paid to Ramasela. Okay, so I did touch on this. Let's go read more about it. Okay, so they say the following distributions must be made. Each beneficiary receives a monthly annuity that must be paid from dividends received. So we have, so when you get a question like this, just write down a summary to say, okay, my beneficiaries are number one, there's Ramasela. Number two, there's Judy. And number three, there's Richard, who's a minor. Okay. And then what is Ramasela receiving? She's receiving 1,000 Rand times 12 months. So that means she's receiving an annuity of 12,000 Rand. And this annuity is paid from dividends. Okay. And then they go on to say additional distributions of income are subject to the discretion of the independent trustees. So that means that no one has an unconditional right to receive anything. They'll only receive something at the discretion of the trustees. So the trustees are the ones who decide that this is what we're paying out and all of that. Okay. So now the first question wants us to talk about this annuity. Do you guys have any idea of how the wife will be taxed on this annuity? Are you guys there?
Yes, I'm not quite sure.
I'm not sure either.
Okay, so let's read the rest of the question and we'll come back to it. So income retained in the trust, Judy has a vested right to 40% of dividend income. What did we say vested means?
Unconditional right.
Yeah.
To the income.
Yeah. So what you do then is you just write your small summaries because there's too much information going on here. So next to Judy, I'm writing 40% vested right to dividend income. I'm just making a small summary for myself. And then they say it has not been distributed. And then Richard has a vested right also to 40% of the income to the of the interest income. Okay, I'll come back to that. And then the trust deed has a condition that it remains in existence until Richard turns 40. So this trust will exist until the last child turns 40, after which the trust assets and any retained income, excluding vested amounts, must be divided equally between the surviving spouses. So basically they're saying when this young boy who is 15 years old turns 40, then the trust must cease to exist. And when that happens, everything, all of the assets and the income will be divided in equal proportions. So let's look at what the trust owns. So number one, the trust owns a block of flats worth 5 million rand. So I'm writing on my summary, there's a block of flats worth 5 million rand, and Mr. Nduli, who's Mr. Nduli? The founder of the trust, or the donor. He donated the block of flats to the trust. So I'm just gonna write trust number one, there's a block of flats. Number two, there's listed South African shares to the value of 4 million. Mr. Nduli's father donated the shares to the trust on 1 March 2020. And then lastly, there's a fixed deposit of 8 million rand in a local bank. Mr. Nduli's mother-in-law donated this fixed deposit to the trust. And then the only other expenditure in the trust was trustee remuneration of 150,000 rand for the year. Okay, so let's have a look at it. The trust apportionment calculations are as follows. Like most of your questions will look something like this. So they are showing you that, okay, this is income from the flat. And which flat is this? This is the flat donated by Mr. What do they call him? Mr. Nduli. And then there's dividends. These are dividends donated by who? By his father. These are from shares donated from his father. And then lastly, there's interest. And this interest is from where? It's from the fixed deposit that his mother-in-law donated to the trust. So that's where the income is from. And then there's costs. These are the costs relating to the flat. And then there's the trustees' fees, 150, which they mentioned. So when you look at your question, like when you find something like this, you must be able to make sense of all of these amounts. You must be able to say, where's this flat rental coming from? Oh, it's from the flat donated by Mr. Nduli. Where are these shares coming from? Oh, they're from the donation made by the mother, by the father. The fixed deposit interest, where is it from? It's coming from the deposit, the fixed deposit made by the mother-in-law, and that the one that she donated. So you must be able to make sense of all of these figures. I know they can look intimidating, but they are not, like, if you really understand what's happening, okay? So then there's the annuity. And they did say all of these people get an annuity of 1,000 rand per month. So it's 1,000 times 12, and that's how they get the 12,000 rand. So you must be able to make sense of the figures. Then there's discretionary payments made in October 2020. So discretionary means at the discretion of the trustees. So they paid Ramasela dividends, and they also paid Judy 50,000 of interest, and they also paid Richard 13,000 of rental. So these are the discretionary payments that were made. And then there were more discretionary payments made in December, okay? And then there were more discretionary payments made again in February, okay? So all of these are discretionary payments made. And then income in trust after the distributions, okay? So remember, they said after the distributions, Judy and Richard have vested rights to 40%, 40%. And then finally, there's income retained in the trust. Okay. So now, the first question wanted us to discuss the annuity, the 12,000 rand that Ramasela received from the trust. Are you guys still there?
Yes.
So now I explained the conduit pipe principle. And I said what the conduit pipe principle basically says that under normal circumstances, whatever flows through the trust, so the trust is a pipe, think of it as a pipe, and whatever flows through this pipe will come out the same way in the hands of the beneficiaries. So you have this pipe that you put in income and assets to, and these income and assets, when they get to the other end, which is the beneficiary's end, they will get in the same way. They will get in the same way. They will get in the hands of the beneficiaries in the same way that they flowed from the donor or wherever. Okay. So meaning that there's the income of the trust is rent, shares, dividends, and it's rent, dividends, and interest. So these rentals and dividends and interest, they get into the trust as rentals, dividends, and interest, and they get out of the trust as rental, dividends, and interest. So the beneficiaries receive rental, dividends, and interest. Now the next thing is, if I'm a beneficiary and I received a dividend, it means I can claim a normal dividend exemption in terms of section 10(1)(k). If I receive interest, I can claim a normal interest exemption in terms of section 10(1)(I), which is 23,000, I think it's 23,800, that interest exemption, okay? However, when this dividend, remember, like I said, under normal circumstances, I should be able to claim an exemption, a section 10(1)(k) exemption. But now, when this dividend is paid out in the form of an annuity, there is no exemption on that. So are you guys following? Can someone give me a summary of what I've just said?
Okay, so basically what you just said is that with the since you explained that it's like a pipeline, whatever gets into the trust goes to the hands of the beneficiary the same way, meaning that dividends and income are exempt in terms of the section 10, né? But when they are paid out as an annuity, then they are exempt. They are not exempt, sorry. Correct. But basically, yeah.
Correct. Asanda, do you get it?
I didn't get it before, but now that she explained, I get it.
So under normal circumstances, the beneficiaries can claim exemptions under normal circumstances. But if this income is paid in the form of an annuity, then there's no exemption there. Okay.
Yes.
There's only one exemption. I want to go back. Let me just go back quickly. Yes. So the section, the dividend exemptions are not allowable as exemptions when the dividend is paid in the form of an annuity. Okay. But if interest is paid in the form of an annuity, then there's an exemption. Am I making sense? Or am I?
So for dividends, it is not exempt, but for interest, it is still exempt when paid in the form of an annuity.
Correct. Local interest. Okay. Local interest.
Oh, only local. Okay.
So can you guys write that down, because I know it's quite tricky. But now, Okay, so the question was saying, discuss the tax implications of the 12,000 rand paid to Ramasela. So the tax implication is that, number one, the annuity will be income in her hands. It will go into her gross income because it's an annuity. Number two, there will be no exemption for that. So those are the tax implications.
So you're saying that this income in someone's hands means that it's going to go into their gross income?
Yes, yes, yes.
I've been meaning to ask. Okay.
Yeah, when I keep saying in the hands of or in someone's hands, I'm in their taxable income, basically.
Okay.
Yeah. So do you guys have any questions there?
So I just want to understand, when this 12,000 goes into the gross income, it'll go in as 12,000 dividend income and then exempt dividend income again or how does it go in? Yeah.
Remember, it's dividend income, but it's coming out as an annuity. So it will go in as an annuity and there will be no exemption. Or you can put it as dividend. You can still say dividend income, but the important thing is there's no exemption.
Oh, okay.
But at the end of the day, it goes into the gross income of this person.
All right, got it.
And then the next question says, discuss the tax implication of the 62,750 distributed to Judy in December 2020. So let's go have a look at it. 62,750, let's see. Okay, so this is the amount that they're talking about. This one over here. So who is Judy?
The daughter.
The daughter who's married, right?
Yes.
So where is this income coming from?
From the flats, rental income from the flats.
Correct. So who will be taxed on this 62,750 and why?
Is it the father, Mr. Ntuli?
Okay.
First, and I think the reason would be because of it's part of the anti-avoidance rules.
Okay, so you are in the right track, except that anti-avoidance provision rule would be applicable to a minor, but Judy is married, so she's not a minor. So the donor, then we tax who? The beneficiary, which is Judy.
What about the donor?
We can't remember, we can only tax him because of the anti-avoidance provisions. But if we can't tax him because of the anti-avoidance provisions, then we move on to the donor, to the beneficiary.
Oh, okay.
So in a nutshell, if Judy was not married, or if Judy was a minor, then you would be right. It would be taxed in the hands of Mr. Ntuli, the donor.
Oh, okay, I get it.
So, for example, if this income was in the hands of Richard, who is a minor, it would be taxed in the hands of who? Of Mr. Ntuli, because he's a minor. So it's the anti-avoidance provisions that make the income go into the hands of the donor.
Okay.
Asanda, are you following?
Yes, I am.
So now we move on to the next question. So your questions are kind of broken down into, like, they give you guidance to say, can you discuss this? Can you discuss that? I don't think your questions will always be like this. Sometimes your questions will just say, calculate all the total income in the hands of Judy or in the hands of Richard or whoever. So, okay. So the next question says,
before you move on to the next question, could you please explain that part for local tax? You said local tax is still exempt. Or
yes, local tax will always be exempt
even if it's received in
the form of an annuity.
Yeah.
Yes.
Okay.
Yeah.
Local interest, ne?
Mm.
Okay.
Mm. Okay. So calculate Richard's taxable income for the 2021 year of assessment, and then where amounts are included or nil in your calculation, provide a brief reason. Okay. So a lot of your lecturers say you guys don't have to know the sections, but I strongly encourage you guys to know the sections, because when they say provide brief reason, what are you supposed to say if you don't know the section, honestly? So there's a mark allocation for the section. So I don't understand. I mean, for the brief reasons, I don't understand why they say you don't have to know the section. So for you guys, please just, just write the sections down somewhere. So when they say provide brief reason, you are able to, when you provide that brief reason, you're able to get a full mark there. But if you just put the amount and you are failing to provide the brief reason, then you can't get full marks there. So, okay, so they want you to calculate taxable income for Richard. So who is Richard? Is he a beneficiary?
Yes. He's the son.
He's the son, right? So we're going to calculate
Yes.
all of his total income, taxable income. So let's start. Number one, he received an annuity of 12,000 Rand. Asanda, can you tell me how we treat this annuity?
How do you treat the annuity? You don't exempt it. It's in, oh yeah, it's in his income, gross income as well.
Can someone tell me why the father is not taxed on this annuity, and why is Richard being the one taxed on this annuity because he's a minor? Can anyone tell me? Okay, let's look at where are these dividends coming from? These dividends are coming from listed shares which Mr. Ntuli's father donated to the trust. So what I'm trying to say is that if these shares were donated by the father, then he would be the one taxed on this annuity. Are you guys following?
Oh, okay, yes.
But in this case, Richard is the one that will be taxed on this annuity, because we can't tax the father. He's not the one that made the donation.
Yeah, it makes sense for me.
It's the grandfather who made the donation. So when we calculate Richard's taxable income, I've got in his gross income, there's 12,000, and there's no exemption there. Okay, let's see what else he received. So the second thing that Richard received, he received 12,200 Rand. You guys see it?
Yes.
And these are dividends again. And he received these dividends in October 2020. So can you guys tell me how we're going to treat these dividends? Is there an exemption? Any attempt? Okay, no attempt. All right. So these dividends are dividend income, correct? Are you guys agreeing with me that it's dividend income?
Yes.
And you guys are also agreeing that this income will not go into the father's hands because he did not donate these shares.
Yes.
So now the next thing is you ask yourself is there an exemption? Yes, there is an exemption. Why? Because these are normal dividends. They are not paid from an annuity.
Yeah.
So the first dividends were from an annuity. They were paid in the form of an annuity. Okay. That's why there was no exemption there. And the second ones now, they are not from an annuity. So that means there's an exemption. So what I'm going to do is I've got a dividend. So the first thing that went into his income was the 12,000. And now he's getting another 12,200. And this time around, there's an exemption of how much of the full amount, because that's what section 10.1K says in terms of section 10.1K.
Yes.
So far, Richard he received 12,000. There was no exemption because it was paid in the form of an annuity. Then he received 12,200, and this time he gets an exemption. So how much is left? What's his balance now? Can someone tell me what his balance is?
Is it 12,200 because of that 12,000 of the annuity which wasn't exempt? So I think it's 12,000 plus 12,000 plus 12,200 and then minus 12,200 again.
Correct.
Then we're left with 12,000. Sorry, we're left with that 12,000.
Correct. So that's his balance because he has received an exemption for the 12,200. Okay. So what else does Richard have? He did not receive anything in December. Okay. And then he received something in February. And how much did he receive? He received 19,220. And still, it's a dividend, but wait. Oh, he actually received a lot in February. So all of these, this is what he received. He received 16,780 rental income, 19,220 dividend, and then 90,400 interest income. Right?
Okay, can I ask? What about that 13,000 that he also received on October 2020?
Oh, thank you so much. I had totally skipped this. Thank you so much. So yes, good, thank you. So this 13,000 Rand, it was from where? From rental income, right?
Rental income, yeah.
Where is this rental income from?
The father, Mr. Dooley.
So who will be taxed on this rental income?
The father.
So it will go, so into Mr. Ntuli's income, you already have rental income of 13,000. And this is, your brief reason would be the section 10, section 7, subsection 3. So,
okay.
So this 13,000 will not be in Richard's taxable income.
Okay, so about this 13,000, when it goes to Mr. Ntuli's hands, is it also, is it exempt there?
No, remember, it's gross income. It's just basic income. There's no exemption there. But if it was a dividend, then he would get an exemption. Or if it then he would get a local interest exemption. But it's just rental income. There's no exemption there.
Okay.
Right. So that means that Richard's balance right now is still 12,000 because the 13,000 is not going in his gross income.
Okay.
So now we have 16,780. Asanda, any idea how we're gonna treat that one?
I have a question first on the 13,000 before we go to that one. I want to understand what you are saying. You're saying that this amount will go to Richard's father's gross income. and not Richard's gross income.
No.
What are you saying?
Oh, okay. So I mentioned Richard's father. Okay, let me explain. So I said, let's talk about the 12,200 first. It is from dividends. And where are these dividends coming from? From shares. Where are these shares coming from? From a donation made by Richard's father. So this income will be taxed, not Richard's father, but Richard's grandfather. So now, the father will not be taxed on this 12,200 because he did not donate these shares. Neither will the grandfather be taxed on these shares because he's not a direct father. So the anti-avoidance provision only works when there's a parent and child relationship. So that's why this 12,200 will be taxed in the hands of Richard, not the father, because the father did not make the donation, and not the grandfather because he is a grandfather. And the anti-avoidance provision says income will be deemed a minus income will be income in the hands of the parent, not income in the hands of the grandparent. So that's why if we can't tax the donor, which is the father, because he did not make the donation, we tax the beneficiary. So that's how this 12,200 ends in the hands of Richard. And then the 13,000 now, where is this 13,000 coming from? It is coming from rental income. Rental income from where? From flats. Where are these flats coming from? From a donation made by the father. So that's why, because of the anti-avoidance provision, this 13,000 will be taxed in the father's taxable income and not Richard's taxable income because the father made a donation.
Okay, so what was my question? What did I say? Because you said no. I want to understand.
What was your question?
Did I not say the same thing?
Were you saying the same thing?
But yeah, I was asking if it's gonna be to Richard's father, Richard's father's taxable income, and not Richard. I wanted to understand that.
Okay. I think I must have thought you said the grandfather, so that's why I started by explaining.
Oh no, the father.
Oh, okay. Yes. So yeah, you are 100% correct.
Okay.
So now, can you tell me what's going to happen to the 16,780?
Is it not going to be treated the same since it's from rental income?
So who will be taxed on it?
Oh no, this is Judy now, not Richard.
No, Richard.
Which one are you talking about?
Richard. We're still on Richard. We are here.
16,780, not 62. Okay, I'm looking at the wrong amount. Sorry. Okay. I think it will be taxed on Richard's father's taxable income as well.
Correct. Asana, do you agree?
Hmm?
Do you agree?
Who agrees?
I mean, Dineo, do you agree?
Oh, okay.
Oh, yes, I agree. Sorry.
Okay. So it means already in Mr. Nduli's income. So like when you get a question like this, you don't wait for them to say calculate Mr. Nduli's income. Like when you get a piece of information, you note it down somewhere on the side already. So already I know that in Mr. Nduli's, there's 13,000 and then the 16,780 rental. So you see, I'm saving time by calculating both of their taxable incomes as I'm moving. So now the 19,220, any idea how we're going to treat that?
That one will be exempt, right? Because it's dividends, normal dividends, and not annuity.
Correct. Can you tell me in whose hands and why?
I think Dineo is gonna tell you.
I'm thinking in the hands of Richard because it's from the grandfather. Yeah.
And not the father, right?
Yes, yes.
Correct, correct. So it means now in Richard's income, we have an additional dividend. One. We have
Yes.
of 19,220. And then I now write the exemption of 19,220. So remember, I can't exempt something that I didn't put into gross income. First, you put it into gross income, then you put the exemption. So, okay. And then there's the 90,400. Any idea how we're going to treat that?
Okay, so firstly, it's from the grandmother, ne?
Mm-hmm.
And it is interest, ne? Yeah, it
Mhm.
was interest from the grandmother,
Mhm.
and it is not an annuity, so it is exempt.
Correct. But even if it was from an annuity, it would be exempt because it's local interest, right?
Okay, okay. And also, it will be taxed on in the hands of Richard because it is the grandmother, right?
Correct. So this
Okay, yeah.
was made by the grandmother. So we've got in the taxable income of Richard, we have local interest. And how much is the exemption?
I think it's 23,800.
Correct. So the exemption is 23,800. Why 23,800?
It is given, it's by law.
But I'm trying to establish whether you're aware that it's not always 23,800. It depends on the age of the taxpayer.
Oh, yes. Ish, yeah. Yeah, can you also go back to that? I remember but quite a bit about it. So with age, maybe I wrote it somewhere. So can you also give us the amounts for the different ages? I think I forgot about that.
Let me just check. But they will be there in your, those annexures that they put at the end of your test or your exam.
Yes.
So it will be, I don't know the exemption by heart, but let me just Google it.
Okay.
Let me just Google it quickly. Section 10(1)(I) exemption 10(1)(I). Okay, let me just check. I think it's 30-something thousand. Let me just double check. I'm not finding it on Google. I'd have to open my textbook. Oh, do you guys have like a textbook with you guys, like a 2021 textbook with you guys?
Yes, I do.
What are we looking for?
We're looking for the interest exemption.
The amount.
Yeah. There's 23,800 for players under the age of 65, and then there's a 30,000 something. That's the figure that we're looking for.
It's 34 something.
Yeah, it's 34,000 something.
34,500 is for over 65.
Thank you. So that's the text. That's the exemption that's there for interest. So that's why I was saying it's not always 23,800. You have to look at the age of the textbook.
Yes.
Okay, but before I forget my question, I've been trying to think of a way to phrase this question for 13,000 for Richard. This 13,000 rands. I want to understand that you said this 30,000 is going to be taxable income to Richard's dad. Even though it was not his income, but an expense to him since he donated the amount to Richard. So it's going to go back to him as an income and not.
Okay.
So what happens to that part that it was out of his?
All right. So, okay. So number one, okay, we have to establish where this 13,000 was from. It's from rent. And where is this rent from? From a flat donated by who? The father. So the father did not give Richard.
Oh, okay.
He donated a property, and the property is the one
flat.
Rent. So there's no expense in the hands of Richard's father. Donated property.
Okay, I wanted to understand that part.
The only thing he did, he paid donations tax, and that's it.
Yeah, when he was donating the flat.
Yeah. So, so we agree that there's 19,220 will go into the gross income of Richard, and then he will get an exemption of 23,800, right? And then lastly, he gets a 90,400. We were talking about this 90,400, and how are we treating this?
Is the exemption not limited to the amount if it's lower than 23,800, since you're saying the exemption will be
thank you so much.
23?
Thank you. So thank you so much. Yes. So if the income was 19,200, then wait. Oh, we are talking about the fixed deposit. It's the one that has 23,800. So yes, on my paper, I did write 90,000 gross income, and then the exemption, yes, it's limited to 23,800. So yeah.
So we're talking about 90,000, not the, because that's dividends. Okay.
So dividend exemption is the full amount, and then the interest exemption is 23,800.
Okay. But if it was the other way around now, which is what I was asking, if it was the 19,000 that's in question as interest, you would limit it to the 19,000, not 23,000.
Correct. Because remember, you can only exempt something which was in gross income. So only 19,000 was in gross income. I can't exempt more than that amount.
Okay, thanks.
Yeah. Do you know any questions?
So far I'm good. Yeah.
All right. So what's the last thing that Richard received? He received 239,000 Rand. Can you guys see that? And this was from interest. So how are we going to deal with this?
Can I try? But I'm not sure. So it's interest from the grandmother. Is it not the same way as the exemption of 23,800?
Correct.
I think so. Yeah.
Correct. So it means that an amount of 239,780 will go into income. So it's 239,780, and then there'll be an exemption.
Yes.
So of 23,800.
Yes.
So were you guys writing these figures down? Can you guys give me taxable income?
Oh, I wasn't.
Okay. Asanda, were you writing the amounts down?
No, I didn't write the amounts down.
Right. So the first one was 12,000 dividend, and this one was from an annuity, so there was no exemption. Then there was 13,000, which was taxed in the hands of the father. Then there was 12,200, which was gross income in his hands, but there was an exemption for it this time around. Then there was 16,780, which was taxed in the hands of the father. There was 19,200, which was taxed in his hands, but there was a full exemption, dividend exemption. And then 90,000, there was an exemption of 23,800 and another exemption of 23,800 on the income of 239,780. So when you add that up, I'm not going to add it up because you guys are not calculating. So, but yeah, that's how you calculate taxable income in Richard's hands. Any question?
Not from me.
Okay. So this was only out of 8 marks. So I think the more you practice this, in fact, I strongly advise you guys to do these questions, send them through to me if you have questions. But the more you practice, the more you'll be able to stick to the time limit. Because if you don't practice, then you're going to spend 30 minutes on this 8 marks only. Okay.
Yeah, it's true.
So the second question, the fourth question is, who will be taxed on the 319,000 retained in the trust, keeping in mind the trust deed condition and why? So let's go see which amount they're talking about. 319. Okay, so it's this amount over here. Can you guys see it here?
Yes.
So this is income retained in the trust. So the question is saying who will be taxed on this income and why? So who do you think will be taxed on this income? Just attempt. What do you think? Is it, remember there's 3 that can be taxed, the donor, beneficiary, or the trust itself. So who do you think will be taxed on the amount?
I'm thinking because it's retained income in trust, will it not be the trust?
Correct.
Okay.
So it will be income in the taxable income of the trust. Remember we said that the trust is taxed at a flat rate of 45%. So that means
yes,
normal tax liability of the trust would be everything that is retained times 45%. However, if the question was asking about this 299,720, who do you think would be taxed on this amount?
The father.
Yeah, he would be taxed on this amount because he made a donation of the property. So yeah, he would be taxed on the 229. So at the end of the day, even though this guy is not a beneficiary, he still gets taxed because of the anti-avoidance provision. So there's the spouse anti-avoidance provision, the minor, non-resident. So if one of the beneficiaries was a non-resident, some of the amounts would go into the donor's income. And then there's also retained income. I think it's section 7, subsection 5. Yeah, it's one of the anti-avoidance provisions that says retained income in the trust will be deemed to be the donor's income. So the 299,720, it will go in Mr. Ntuli's income, but the 39,000 will not go in his income because he did not donate the shares. And in the 319 also, it will remain in the trust. So at the end of the day, the trust will be taxed on what? On the 39,708 and 319,670 times 45%. You guys happy there?
So the grandparents are never taxed on the trust?
No, because the anti-avoidance there's no provisions which say that they will be taxed. The only taxation for them would be donations tax.
Oh, okay.
Yeah.
Okay.
It will be donations tax, and then there'll also be capital gains because you're donating an asset of a capital nature. So that means you pay CGT and then you also pay donations tax. But how do you then pay CGT? You use the market value of the property or the market value of the shares less the base cost, and then they pay capital gains on that, and then they also pay donations tax on that. So I did CGT and a donations, like I did it at a CGT and donations tax question with someone else. I think it was just a lecture, not a question, but I'll send you guys the recording.
Okay, please do.
Yeah, so it deals with capital gains, that like the relationship between capital gains and donations tax.
All right.
The next question then says, what are the tax consequences of the 39,708 retained in the trust? So let's go back and see. So yeah, we've already spoken about this. Asanda, do you want to try and answer this one? Janelle, do you want to assist her?
We had said that it will be taxed by on the trust because it can't be, it's a donation from the grandparents, and we don't have, there's no need to tax the grandparents on the trust because there's no anti-avoidance rule for that. Correct. So it's basically taxed on the trust itself.
Okay. So the last question I have for you guys, can you guys calculate the normal tax liability of the trust? So can you do that?
With the normal tax calculation, we need the tax tables, ne?
No, you
we don't
need the tax tables if you're dealing with a special trust, and special trusts are not part of your scope.
Okay.
With an ordinary trust, the flat rate is 45%.
Oh, okay.
So basically, you just say 39,708 plus 319,670 times 45%. That's the normal liability of the trust, because the 290 will go into the income of the donor, which is Mr. Ntuli.
Mr. Ntuli. Okay, got it.
So trusts are very easy. I think the tricky part is understanding the anti-avoidance provision to say who is taxed on this amount, who is taxed on this amount, and then understand what they mean by a vested right or, you know, a discretionary right. Yeah.
Okay. Yeah.
And then there's also that annuity, the annuity thingy, where what's an annuity? What happens when there's an annuity? There are no exemptions.
Yeah, I've got it.
The interest, except the local interest exemption.
Yes.
So that's it, guys. Any questions?
So other than that, is this how they normally ask this question on trusts?
Yeah. This is how most of the times they'll give you the income of the trust. They'll give you all the information you need. Basically, you just have to understand, you know, this is how it'll look like most of the times. Can you see this one that I'm showing you guys?
Yes.
Yeah, you always have something like this where they tell you these are the beneficiaries, and you have to look at the type of the beneficiaries to say, am I dealing with a minor? Am I dealing with a spouse? Am I dealing with a non-resident? Who is this beneficiary? The next thing you want to find out, what exactly is in this trust? Is it interest? Is it dividend? What is it? And then the next thing is, who is going to pay tax on this income? And that will depend on factors such as who made a donation. You know, is there someone who donated this interest or shares? Yeah, so you always have something like this, and they'll ask you to calculate taxable income of the beneficiaries or the donors. It will always be something like this. You always have something like this.
Okay.
But it's very easy. You just have to know the anti-avoidance provisions.
Yeah.
Mm-hmm.
I think I'm okay so far. Yeah, I think I'm good.
So I encourage you guys to please do at least 2 or 3 more of these questions and send them through for me to review. So because we don't have time to do a whole session discussing another question, we have to move on to other things. Just whatever question you attempt, send it to me and I'll just send a voice note, commenting on your answers, so that even though we don't have much time, at least we'll try to cover as much ground as possible.
Okay. So can we do estate duties on our next session?
Okay.
And
yeah.
Because what field do you get with the estate duty? Is it also as simple as trusts or maybe a bit complex?
It is quite complex, but it is quite complex. That's why I didn't want to do it together with trust, because there was no way we were going to cover, because both are like quite big topics. So there's no way we were going to be able to cover both of them in one session.
Okay. Yeah, makes sense.
Asanda, do you have any questions? Is there something that you specifically want us to cover in the next session?
I have no question. I think I want to do donations tax since it's the following one, but I'll try and do it on my own first and the estate duty and see which one is giving me more problems then, and maybe I'll give you the final answer.
Cool. So like I said, we don't have much time, so some of these things I'll, like, if I've already covered something with other students, I'll just share the recording with you. For example, I've covered donations tax and CGT. I'm not going to cover it again with you to save time, but I will send you the recording and then you'll watch the recording and send through your questions.
Okay.
I'm not going to do donations tax. I'll send you the video, and then in the next session, then we will look at estate duty. Is that okay with you guys?
That's okay with me.
All right. So I guess that's it for today.
All right. Thank you so much. It was so insightful.
All right. Bye, guys.
Okay, thank you. Bye.
Bye.